There's a three-digit number that can determine whether you get an apartment, what interest rate you pay on a car loan, and sometimes even whether you get a job offer. Most people have heard of credit scores, but almost nobody knows exactly how they're built, and that gap in knowledge costs people thousands of dollars over their lifetimes. Today we're pulling back the curtain on the actual mechanics of how credit scores are calculated. Let's start at the foundation. A credit score is a statistical model, a number generated by running your credit history through a mathematical formula to predict one specific thing: the likelihood that you will miss a payment by 90 days or more in the next 24 months. That's it. It's not a measure of your wealth, your income, or your financial wisdom. It's a risk prediction tool built for lenders. The most widely used scoring model is the FICO score, created by the Fair Isaac Corporation back in 1989. There are also VantageScore models developed jointly by the three major credit bureaus. Both systems use a scale of 300 to 850. But the formulas differ slightly. When lenders talk about pulling your credit, they're almost always pulling one of these scores, though which exact version varies by lender and loan type. The score is generated from data sitting in your credit report, which is maintained by three separate credit bureaus: Equifax, Experian, and TransUnion. These bureaus collect payment history from banks, credit card companies, and other lenders. Because each bureau collects data independently, you actually have three different credit reports, and potentially three slightly different scores. This is why checking your score through one source doesn't always match what a lender sees. FICO publishes the general weight of the 5 categories that build your score, and understanding each one reveals a lot about how the system thinks. The biggest slice, 35%, is payment history. This is the single most influential factor, and the logic is straightforward. The best predictor of future behavior is past behavior. Every on-time payment is a positive signal. Every late payment is a negative one, and the scoring model pays close attention to how late, 30 days, 60 days, or 90-plus days, because each threshold represents a meaningfully worse risk signal. Bankruptcies, foreclosures, and collections also live in this category and carry heavy penalties that can persist on your report for 7 to 10 years. The second factor is amounts owed, which makes up 30% of your score. The most important metric here is credit utilization, the ratio of your current credit card balances to your total credit limits. If you have a $1,000 limit and carry a $900 balance, your utilization is 90%, which the model interprets as a stress signal. Research behind FICO's model showed that borrowers using a high percentage of their available credit were statistically more likely to miss payments. Lower utilization, generally considered under 30% and even better under 10%, is associated with lower risk. Importantly, this calculation applies both to individual cards and across all cards combined. Third is length of credit history, worth about 15%. The model looks at the age of your oldest account, the age of your newest account, and the average age of all accounts. Older credit histories give the model more data to work with, which generally translates to more predictability and a better score. This is why closing an old credit card can sometimes hurt your score. It can shorten your average account age over time. Fourth is credit mix, at 10%. Lenders like to see that you can manage different types of credit responsibly. Revolving accounts like credit cards, and installment accounts like mortgages, auto loans, or student loans. Having variety signals broader experience with debt management, though this factor carries the least weight and isn't something worth manufacturing artificially. Fifth is new credit, also 10%. Every time you apply for new credit, the lender typically performs a hard inquiry on your report, and each hard inquiry can temporarily lower your score by a small amount, usually fewer than 5 points. The model interprets multiple recent applications as a potential sign of financial stress or aggressive credit seeking. There's an important exception built into the system, though. For mortgages, auto loans, and student loans, multiple hard inquiries within a short window, typically 14 to 45 days depending on the version, are counted as a single inquiry, because the bureaus recognize you're rate shopping for one loan, not applying for many. To understand why the system works the way it does, it helps to know where it came from. Before credit scoring became widespread in the late 1980s and 1990s, lending decisions were largely subjective. A loan officer would review your application and make a judgment call. The problem was that these judgment calls were inconsistent and frequently discriminatory. Race, gender, marital status, and neighborhood played informal roles in lending decisions. Statistical credit scoring emerged partly as a solution to this inconsistency. By reducing a borrower's profile to a single number derived from financial behavior alone, the system aimed to make lending more objective and scalable. The Fair Credit Reporting Act of 1970 and the Equal Credit Opportunity Act of 1974 had already established legal frameworks to protect consumers, and scoring models were seen as a way to operationalize fairness. The psychology embedded in the model also reflects decades of behavioral data. The heavy weighting on payment history reflects the statistical reality that payment behavior is the most consistent predictor of default. The sensitivity to utilization reflects research showing that borrowers who max out available credit are in a structurally different risk position than those who don't. The model isn't making moral judgments, it's pattern matching against historical data about millions of borrowers. This also explains why the system can feel counterintuitive. Someone who has never used credit at all, no credit cards, no loans, can have no score whatsoever, sometimes called being credit invisible. The Consumer Financial Protection Bureau estimated that tens of millions of Americans fall into this category. From the model's perspective, the absence of data is just as unresolvable as bad data. It simply can't make a prediction. This is a well-documented limitation of the system that consumer advocates have pushed to address through alternative data sources like rent and utility payments. One of the most important mechanical realities of credit scores is that they are not static. They recalculate every time a lender or bureau updates your file, which can happen monthly or even more frequently. This means the score is a snapshot, not a permanent verdict. Negative items don't last forever. Under the Fair Credit Reporting Act, most negative information, late payments, collections, charge-offs, must be removed from your credit report after 7 years. Bankruptcies under Chapter 7 can stay for 10 years. Chapter 13 bankruptcies typically come off after 7 years. And critically, even while negative items remain on the report, their impact on the score diminishes over time. A late payment from 5 years ago carries far less mathematical weight than one from 6 months ago. The score also responds to positive changes relatively quickly in some areas. Because utilization is calculated based on current balances, paying down a credit card balance can improve a score within the same billing cycle once the new balance is reported to the bureaus. Payment history improvements are slower. Consistent on-time payments build a track record month by month. There's also the concept of score versions to be aware of. FICO alone has released multiple versions. FICO 8 is currently the most widely used. But FICO 9 and FICO 10 exist, and mortgage lenders often use older versions like FICO 2, 4, or 5 because those were validated for that specific lending context. VantageScore is now on version 4.0. This means 2 lenders can pull your credit score in the same week and to see different numbers. Not because something changed, but because they use different models. So let's bring this all together. A credit score is a statistically generated risk prediction number built from 5 weighted categories: payment history, amounts owed, length of history, credit mix, and new credit. All sourced from data on your credit report maintained by 3 independent bureaus. The system has historical roots in attempts to make lending more consistent and scalable, and it reflects decades of behavioral data about how borrowers actually behave. It has documented limitations, including leaving credit-invisible individuals without a score at all, and it operates through multiple competing models that different lenders use for different purposes. Understanding the mechanics of how credit scores work is genuinely useful financial literacy. Not because it tells you what to do, but because it demystifies a system that touches an enormous number of financial decisions in most people's lives. When you understand how the math works, the system becomes far less mysterious. If you found this breakdown useful, consider subscribing to the channel. We publish explainers like this regularly on how money systems actually work under the hood. And if there's a financial mechanic you've always wanted explained clearly, drop it in the comments. We read them all.